Markets don't pay you for effort. They pay you for taking priced risk, providing scarce liquidity, or owning a claim on cash flows. Labor income is linear and capped by hours, while capital income is nonlinear and scales with exposure. If you want rich, you have to stop thinking like a worker who gets rewarded for trying and start thinking like a portfolio manager who gets rewarded for positioning. So we're going to run this like a private investment lab. Incentives first, then cash flow, then risk, then execution. Here's the core mechanic. Your job is an expense line on someone else's income statement. Even if you're elite, the market doesn't re-rate your wages the way it re-rates an asset. An asset is a claim on future cash flows, and its price is basically a negotiation between time horizon, discount rates, perceived risk, and liquidity. When rates rise, the same future cash flows are worth less today. When liquidity dries up, even good assets get marked down because forced sellers don't care about your spreadsheet. When volatility spikes, the cost of being wrong goes up, so position sizes get cut, margins tighten, and prices gap. That's the market's biomechanics. Incentives push capital towards scalable cash flow, rates set the gravity, liquidity sets the friction, volatility sets the penalty, and positioning decides who gets squeezed. Strategically, this matters because hard work mostly improves your earning power, not your ownership. Earning power helps you save, but saving is not wealth, saving is the fuel. Wealth is what happens when fuel is converted into an engine that produces cash flow without you being present. Businesses, equity, real estate, royalties, productive assets, or a portfolio with positive expected value over long horizons. Most people misunderstand this because they confuse effort with value and confuse income with equity. They'll grind for a higher salary and feel ahead, but they're still renting their time. Meanwhile, the people who get rich are usually accumulating claims, a slice of a business, a slice of many businesses via stocks, or a contractual right to cash flows. That's why you can meet someone who works 80 hours and stays fragile, and someone who works 30 hours and compounds, because compounding doesn't care how tired you are. It only cares about time, rate of return, and not blowing up. Now we apply it like a trader-investor hybrid. Calm, rules-based, no ego. Imagine you're starting from scratch with a stable paycheck. Your paycheck is not your wealth plan, it's your capital-raising phase. Your first move is to protect your runway because the fastest way to stay poor is to force sell. You build a cash buffer sized to your real volatility. If your income is shaky, you hold more cash. If your income is stable, you can hold less. Cash isn't lazy here, it's an option. It gives you the ability to act when prices move instead of begging the market to cooperate. Then you decide what game you're playing. If you're building wealth, your default exposure is to broad, liquid, productive assets with a long time horizon. Because the edge isn't prediction, it's participation plus risk control. You enter with a size that lets you survive boredom and drawdowns. Your position sizing is your opinion expressed in dollars, and most people accidentally express an opinion that's too loud. If an asset can drop 30 to 50% in a bad year and you'd panic sell, you're oversized. So you scale in. You don't go all in because all in is a confession that you haven't modeled uncertainty. Now watch the market and respond, not react. If the market sells off while earnings and cash flows are broadly intact but rates are rising, you assume valuation compression is the primary driver. Your response isn't to chase a bounce, it's to rebalance according to a preset rule. You add exposure in increments as prices fall, and you cap your total risk so a deeper drawdown doesn't force you out. If the market is ripping higher on expanding liquidity, easy credit, narrowing spreads, volatility collapsing, you resist the urge to size up just because it feels safe. Safety is cheapest right before it disappears. You take profits the same way you entered, in slices, according to a rule, not a feeling. Your exits are not because I'm up. Your exits happen when the thesis breaks, when the risk/return flips, or when concentration crosses your risk limit. If you own a single stock because you Worked hard researching it. Remember, the market doesn't reimburse research hours. The market pays you only if your thesis is right and your position size doesn't kill you while you wait. So you define your invalidation point up front. If fundamentals deteriorate, cash flow, margins, balance sheet, competitive position, you reduce. If liquidity conditions change, spreads widen, funding costs rise, volatility regime shifts, you reduce leverage, shorten time horizon, or move up in quality. Common failure points show up fast. You get overconfident after a win. You chase because you feel behind. You ignore time horizon and turn an investment into a trade or a trade into a long-term bag. Here's where most people stop, but here's the advanced layer. Wealth isn't just buy good assets and wait. It's understanding regime shifts and second-order effects. In one regime, stocks and bonds diversify each other. In another, correlations converge and everything falls together because the real driver is liquidity and funding stress. When that happens, your spreadsheet can be correct, and your portfolio can still be wrong. This is where you respect risk of ruin math. A 50% drawdown requires a 100% gain to get back to even, and that recovery time is the hidden tax on your future. So the advanced operator treats drawdown as a cost to be minimized, not a badge of toughness. They keep optionality, cash, high-quality liquid assets, and position sizes that allow re-entry. They also recognize liquidity traps. The price can keep falling not because value is gone, but because sellers must sell. If you don't know whether you're early or wrong, you don't average down aggressively. You average down mechanically, within strict limits, and only when survival is guaranteed. Now you integrate this into a skill, not a vibe. You train it like a craft. A checklist before entries, a journal after decisions, and a weekly review loop that tracks what matters: exposure, drawdown, concentration, and whether your actions matched your rules. You backtest simple rules so you internalize how different assets behave under different rate and volatility environments. You simulate scenarios: inflation up, growth down, rates down, liquidity up, volatility spike, spreads widen. Then you build a small playbook in your own words, so you can execute under pressure without improvising. To retain it, you use constraints. You set a max loss per position, a max portfolio drawdown you're willing to tolerate, and a rule that you don't increase size after a winning streak without re-evaluating volatility. You combine tools instead of worshiping one. Valuation tells you what you're buying, macro tells you what gravity is doing, technicals tell you where positioning might force moves, and risk management tells you whether you live to see the next setup. You test under pressure with paper trading first, then tiny sizing, and you run pre-mortems. If this goes wrong, how does it go wrong? Rates, earnings, liquidity, or me? Then you stress test. If this drops 30% next month, do I add, hold, or cut? And what rule triggers that? If you replay this, listen for the quiet detail that changes everything. Cash isn't a return drag in a liquidity-driven world. It's your ability to avoid forced selling and to buy when other people can't. That one mechanic is the difference between working hard forever and using work to acquire ownership that compounds without you.